You have now completed a couple of problems dealing with depreciation. You had to calculate and then record into the journal and into the ledger transactions involving depreciation. As you know, major assets of a business eventually wear out, and in order to keep our books as accurate as possible, accountants need to calculate and record either annual or monthly depreciation, depending on the accounting period that a business uses. So we're going to look at a video here that will show what happens at the end of that long period of time when the asset wears out and we either sell it for a salvage value, or we trade it in, or we simply get rid of it. So we'll take a look at how that works. On your screen you see the general journal for the Delphus ice rink. You had a problem recently involving this company where you had to calculate and record depreciation for an ice resurfacing machine called a Zamboni. Now we're going to assume that we are in the future and we're going to sell that ice resurfacing machine. On the right, information tells us that on January 1, 2019, the Delphus ice rink bought a new Zamboni ice resurfacing machine for $23,000. The business estimated that the machine would have a useful life of 12 years. At the end of those 12 years, the trade-in value would be $500. So the amount of annual depreciation we calculated on the problem you had recently, at least you should have calculated that annual depreciation amount to be $1,875. So our ice rink uses an annual accounting period. Now, let's go into the future. Let's assume that it is now 12 years later, and you have graduated from high school, you've graduated from college, and you now are the accountant for the Delphus ice rink. And the business now wants to sell that Zamboni for $500 cash on December 31, 2030. This is 12 years after it was originally purchased. As the accountant, you now need to make the proper entry into the journal at the left and then post it to the general ledger. Now, before we begin this, one important note. This is a new transaction that you have not had before. You've had many transactions that deal with a debit to cash and a credit to sales, or a debit to accounts receivable and a credit to sales. This is not a sale. The Delphus ice rink is not in business to sell Zambonis. So from time to time, though, it does sell an old asset, and that's what we're doing here. So we do not use the sales account here. So that's important. Now, before we get into the transaction in the journal, let's take a look at what we need to look at in the ledger. So we go to our tab at the bottom, as always, and we click on that, and I'm showing you 3 asset accounts. And we only need these 3 in this particular instance, so that's all we are showing. First of all, we have cash, our typical cash account, asset 101, and there's nothing in it because it's not necessary for this demonstration. At this point, the cash account would undoubtedly have many debits and many credits, but they're not relevant to this demonstration, so I'm not showing them. But let's take a look over here. This is important. The Zamboni has an account. It is an asset, account number 104. And remember, we are now assuming that the year is 2030. But this account shows that on January 1, 2019, we bought this Zamboni for $23,000. Nothing has been done. It's 12 years later. Nothing has been debited or credited. This account stays the same. And it shows that same amount on the balance sheet each and every year that we construct the balance sheet, because the owners need to know what we originally paid for this. The other important account that goes along with this is the accumulated depreciation for the Zamboni. And this also would be shown on the balance sheet. And I've filled in what entries there would have been for the past 12 years. At the end of the first year, December 31, 2019, we would have debited an account called depreciation expense for the Zamboni, and we would have credited this account, accumulated depreciation for the Zamboni. And we just figured out a minute or so ago that the annual amount of depreciation using the straight line depreciation method should be $1,875. So that was recorded. At the end of the next accounting period, that same transaction would have been made. We would have debited on December 31, 2020, depreciation expense for the Zamboni, and we would have credited this account, accumulated depreciation, for $1,875. The next year, we do the same thing. The same entry is made. So if you look down, you see that at the end of each of the 12 years, we have recorded in the accumulated depreciation account the amount of $1,875. So each time depreciation expense would have been debited, and each time this account would have been credited. So that at the end of the 12 years, the balance showing in this account is $22,500. So now we're ready to go back and take a look at the journal entry and then post it to these three accounts. So we go back and we will assume that this date is December 31, 2030, and we are selling the Zamboni. Now, we are selling it, but we're not considering this as a revenue transaction, so we don't credit sales, remember. But we do debit cash. We got money, so we debit cash, and the amount that we got for this, if you look over here again, we will assume that the business sells the Zamboni for $500 cash. So not accounts receivable, but cash is debited by $500. So that part is relatively simple. Now, the second part of it is a little more complicated. There will be another debit and a credit to this transaction, and involving the two accounts we just looked at. First of all, let's look at the account for the Zamboni itself. We will credit this account. Now we do that because over here in the ledger, we want this account, the Zamboni account, to have a zero balance. We are selling it, we no longer have it, we need to clear it off the books, a phrase that accountants sometimes use. We are closing the account or clearing it off the books, which means this account needs to have a credit balance. This account has to have a zero balance. In order to do that, we do need a credit of $23,000. So that's why back in the journal, we need to credit $23,000. Now, that amount is used because that's the amount that's in the account in the ledger. And we'll post that in a moment. The third account that's used is that other one that I showed you a moment ago in the ledger, and that will be another debit, as we will see. Accumulated depreciation for Zamboni. Now, what we want to do is to look at that account in the ledger and realize that in order to close this account, it has a credit balance of $22,500, so we need to debit by $22,500. So that's why back in the journal we need another debit, and that's our transaction. So we have two debits and a credit. If you add up the two debits, they equal $23,000, and the credit is $23,000. Remember, debits always must equal credits in every transaction. So our description, we sold the old Zamboni. Okay, that's what that transaction does. Now we simply go back and post it. So if we go to our cash, this is December 31, 2030, and the debit is 500. That's all the money we got for it. And the reference column was, I think, J13, journal page 13, I believe. And the account number, as always, for cash is 101. And now we will go and post this part of the entry. Zamboni is credited by 23,000. So the date is the date of the sale. And the credit of 23,000 means that the balance is now 0. So we've closed out that account. And 104 is the account number, and that goes in to the journal. And then finally, the same thing happens with the third line here. Accumulated depreciation is debited by 22,500. So we put the date again. And that account now has a 0 balance. It has been closed. And J13, and this is 104.5, which goes back to the journal. So now we've completed the journalizing and the posting of this transaction. So this is what it looks like. We are getting cash, but we're not making a sale. We are getting rid of an asset. So we credit that asset. And if we get rid of the asset, we don't need the accumulated depreciation account anymore. So we debit that by its balance. So these accounts now have a 0 balance. Okay. If we buy a new machine, then we probably will create a new account for it, and also a new accumulated depreciation account for that new Zamboni if we buy a new one. But at this point, we haven't done that. We've just simply sold the old one. So go back over this video if you need to make sure you understand how this works, because you may see a similar problem to this in the test that's coming up in the near future. At this point, go back to your course page. There's another video I want you to watch today, and there are questions after that video.